Let's talk about behavioral finance, because this is really one of the biggest areas where investors can crush their own investment results. I mean, let's think about it. In reality, you are your own worst enemy. And really, the biggest thing a financial advisor can do for you is to protect you from yourself. Look here at 20-year annualized returns on this graph from 1996 through 2015. A professionally managed 60-40 strategy, 60% stocks and 40% bonds, generated an annualized return of 7.2%. So what do you think the average investor got? The average investor generated an annualized return of only 2.1%. That's awful. Tony, why the bad performance?
Misbehavior, Mark. Selling low when there's fear and panic, and buying high when there's hype and greed. Nobody makes money that way.
Exactly. And the issue is people make decisions emotionally, not logically. I mean, think way back to when we were cavemen, right? And the bear's chasing us. What do? We run. Do we stop, assess the situation, look around, and actually see that we could jump up and grab on a branch and lift our feet? No. We make our decisions emotionally, not logically. Now, what about financial advisors? Can they also be overtaken by behavioral finance issues?
Absolutely. We had a lot of left-leaning people wanting to pull money out of the market prior to the election. Turns out that would have been a bad move.
Exactly. I mean, what if we as financial advisors would have listened to all of these concerned people and then allowed it to affect our investment strategy by reducing our equity exposure? It would have crushed our performance. That's why it's so important that we stick to a disciplined investment process and block out the noise. Can clients become noise? Yes, they can. If you have a lot of clients walking through the door talking about how scared they are, and you're working with an advisor who doesn't have a disciplined process in place, he or she can absolutely listen to that noise and make bad investment decisions and commit behavioral finance errors just like the common investor can. Now let's talk about some different behavioral finance concepts. First one's overconfidence. That's a huge issue. I mean, if you think about it, we're all overconfident. We all think we're better looking than we really are. We all think we dress better. We think we drive better than we really do. We also think we have the ability to pick better investments than everybody else. We also want to believe that we're not going to be the average investor and get 2.1%, that we're going to get our 5, 6, 7%, or because we're really smart and really overconfident, we can get 10 if a 60-40 portfolio got a 7.2. That's a recipe for disaster. Another one's excessive trading. So studies have been done, and it has been confirmed that those people who trade the most frequently experience the worst returns. Why? Well, number one, they're just making the wrong investment decisions. There's also trading costs, number two. And number three, there's potentially taxable events when they're buying and selling these different investments. The third one I want to talk about is confirmation bias. And people do this all the time. Confirmation bias is where you make your decision and then you go back and you try to find the evidence that supports your decision, completely ignoring any of the evidence to the contrary. Obviously, that's going to set you up for disaster, and we want to make sure that we are not making our decision first and then trying to find the supporting evidence, but rather we're investigating all of the available evidence, and once we've looked at it all, then we finally make our decision.
Look how bad behavior can crush returns. 6 of the 10 best days occurred within 2 weeks of the worst 10 days.
Yeah, no matter how much fear and panic exists in the market, it remains super important to stick with your investment strategy. Be disciplined. Let's explore this bar graph. So here you can see that if you were fully invested Over the course of a 20-year period from January of 1996 through December of 2015, if you remained fully invested the entire time, no matter how afraid you might have been, your return was 8.18%. If you missed just the 10 best days in the market, your return would go from 8.18% down to 4.49%. I mean, you almost lost half of your performance. Then if you missed the 30 best days in the market, you got a negative return, negative 0.05%. If you were really unlucky and you thought you were smarter than everyone else, the smartest person in the room, and you were trying to time the market and you missed the 60 best days in the market over the course of 20 years, what is that? That's 3 days a year that you missed? If you missed those, you got a negative 5% annualized return. That's why it's so important to stick to a disciplined investment strategy and don't allow behavioral finance errors to overtake your thought process.
Mark, I'd also like to point something out with this chart. That time frame, that 20-year time frame you keep on talking about, there were two fearful points in that 20-year period, the tech bubble and the Great Recession. And the Great Recession was extremely, intense and volatile. And if you had gotten out of the market or, shifted all your money to cash and just sat there, look how the returns could have really, escaped you.
Without a doubt. When you look at the annualized performance, you could certainly end up missing out on a ton of upside. I mean, the market, the S&P 500, bottomed at 666 in March of 2009. Now it's up over 2,000. What if you thought you were the smartest person in the room and you cashed out of all of your stocks and shifted to bonds when the S&P was at 1,000? Well, you thought you were really smart when you cashed out at 1,000 and it went to 666. However, you weren't quite that smart when it went then from 666 back up to 2,000 because you missed out on those gains. In a static buy and hold strategy, look at the portfolio drift on a 60-40 portfolio. That's 60% stocks, 40% bonds. What started as a 60-40 portfolio in 1997 was completely out of whack. It was a lopsided 65-35 in October of 2007, and we all know what happened after that. The market crashed. Losses would have been minimized had the portfolio been at 60-40 prior to the crash. This shows the importance of systematic rebalancing. What does systematic rebalancing do? It is a simple, emotionless process that controls bad behavior by forcing you to sell high and buy low. Remember, nobody makes money buying high and selling low. The beautiful thing about systematically rebalancing is you will be selling high and buying low by default. It improves your risk-adjusted returns in the process. In fact, look at the value add when you automatically rebalance once per year. You can see on the left that return increased by 0.4% annualized for doing basically nothing. Also, the risk decreased by 0.2%. I have to tell you, this is one of the easiest things that anyone can do, as long as you don't let bad behavior sidetrack you. What might someone say when they've started off at 60-40 and they've drifted to 65-35? Well, the stock market has been doing well, I don't want to rebalance. That's the worst thing to do. This is a mindless strategy that adds real value. Don't screw it up.
Mark, I want to go beyond a little bit and talk about the pie chart for March 2009. If we take a look at that chart, 48% of somebody's portfolio was in stocks because they've gotten beaten up so bad in 2008. And for how painful and scary it may have been to rebalance, nobody wanted to stick their toes back in the market, but if you would have been disciplined and made your allocation change back to a 60-40, where do you think you would have been?
You would have made a heck of a lot more money because what you effectively did by systematically rebalancing is you bought low, right? And that's the beautiful thing about this. It forces you, without thinking, without emotion, to buy low and sell high, and it adds 0.4% per year of value to you without you even thinking about it. So how can you afford to really mess this up? How well are you managing your wealth? Are you taking advantage of all opportunities that are available to you? Just as it makes sense to have regular physical checkups to make sure you're maintaining optimal health, it also makes sense to do a regular checkup on your financial situation. Our Wealthalize tool provides you with that diagnostic. Simply complete our online questionnaire in under 15 minutes. Our proprietary software will analyze your investment strategy, tax situation, asset protection, estate planning, charitable giving, and your professional relationships. You'll immediately receive a score ranging from 0 to 100, which assesses your situation. Additionally, you'll receive a SWOT analysis, which identifies your strengths, weaknesses, opportunities, and threats that could impact your wealth management. Visit today, www.wealthalize.com.